I think the issue for us is that we're an indirect investor, so the ability to access Southern Europe on an attractive risk-adjusted basis is difficult. I think the investors who are out there are looking at different types of returns than our investors, and I think we have to ensure, or we have to get our investors on side with regards to the opportunity in Southern Europe. It's a lot easier for them to understand what's happening in Western Europe. You know, they're present there themselves. And despite some of the headlines in terms of what's happening in Southern Europe, there's a caution that actually, you know, the occupier isn't there, or the economy isn't there to support that without, you know, any suggested investment. So, do we see an opportunity there? Yes. Can we access it? Questionable. And do we want to take the risk by going that further out? You know, we've struggled historically, or we have had to struggle with trying to generate liquidity from some of our holdings, and when that liquidity goes, it's not there at all. And then we've also tried to manage managers out there, and the landscape for European or Southern European managers is vastly different to that in Northern Europe. So those questions, which aren't really perhaps investment based or, you know, property based, which perhaps hold us back from really making efforts to go out there and really explore the landscape.
Yeah, I think that, you know, that's a very good point, north relative to south. I think in Northern Europe, in the UK, Germany, maybe France, certainly Scandinavia, you know, even in the horrendous times of 09-10, you know, there was underlying liquidity. The REITs recapitalised, they're in reasonable positions. In Southern Europe, you know, most of the listed property companies were severely stressed or very, very stressed. So the liquidity did completely dry up. There was hardly any deals going on down in 2010, 11, Spain and Italy, Portugal. So, you know, buyer beware in the sense that when things are really tough, Northern Europe can still perform from a liquidity. You can still get stuff done, where it completely dried up in Southern Europe.
It's your exit that you have to look at. So if these markets at the moment look attractive on entry, but, you know, where's the exit? I think some of the money that's coming in is very short-term money, you know, medium-term money. A lot of our investors are perhaps more medium to long term, and that's where the difficulty is in terms of, okay, today it might look attractive, but where are we going to be when, you know, QE does pull back, perhaps when it's going to, when interest rates do rise, when there is more visibility in terms of the risk landscape across Europe, which has become a bit more harmonised, but not for the right reasons. We have to bear in mind what's happening at the macro level, because we can't get in and get out quickly. We can take perhaps advantage of some secondary opportunities, but, you know, again, you run the risk of what the structure is on the indirect side, and then we could perhaps try to incubate perhaps new funds, and then look for a shorter term exit. But, you know, again, you're relying on the liquidity being there in 2 years' time, 3 years' time, and we're playing in a slightly different field to some of the American ones.
Yeah, and I think, you know, Madrid office rents are still in a trough, right? I think. You know, they might rise 5% in 2015, 10% in 2016. You know, relative to other European office markets, you know, we've seen a huge re-rating of rents in London. You know, similar in Paris. In Germany's not bad. So, you know, relative, you could argue that there's a rental recovery story to play in Madrid and Barcelona and Milan and Rome offices. But is that already in the yield?
I think regarding the liquidity aspect, which is a very good point, I think something has changed in that direction as well, because with the effective recap and the new SOTIMIs and the new listed sector emerging with the 3 billion that has been raised in total, together or in parallel with the restructuring of the previous listed sector, we are going to have more liquidity from the public equity markets, which I think was a very structural thing missing in the Spanish real estate sector. Yes, we had listed companies, but they tend to be a mix of development and land banks and standard investments, which was not a kind of a pure play.
And French property companies.
French property companies, you're right. Normally with excessive leverage. I think those have been restructured into more kind of common standard investment platforms, recap, and now we have the new SOTIMIs. So all in all, I think that will help to generate more liquidity through the indirect markets which I guess is good. However, it will still be important to know that they will never be as liquid as any other markets in North Europe. It's a good one.